So, good evening. Oops. Good evening, everybody. Thank you for coming. I think most of you know I'm Rhoda Shermer, and I'm welcoming you on behalf of Network for Responsible Public Policy. We have a great program for you tonight. I wish this audience were full. They're missing out. They'll have to get the video. Anyway, before we move on to the great program we're having tonight, I want to make a couple of announcements. First, I want to thank the League of Women Voters of Fair Lawn and the League of Women Voters of Northern Valley for their support. And some of their material is out on the table. You can grab it when you leave. I also want to inform you about a couple of programs that are coming up. We have an amazing lineup for this fall. Tonight is the first amazing program, but we have several more. We're bringing Lawrence Lessig here, and that will be at Ridgewood High School. He'll talk about his book and his ideas about how America is compromised. We have another speaker coming October 17th. That will be back at our home base at the Wilson Auditorium, and that is Michael Lynch, who's going to talk about his new book, Know-It-All Society. Maybe you even heard him interviewed this past week on a number of news broadcasts. We have a bunch of other programs too. We're going to have programs on the voter rights, gerrymandering, and the Mueller report. That will be in November. We have David K. Johnston coming in November. So we have quite a lineup. And I hope you'll stay tuned to our website where you will find all these events posted as we finalize the information. And I certainly will keep you looped. I always do. So our format tonight is going to be where our speakers, Nicole Gelinas and William D. Cohn, will make their presentations. Then they will have a little bit of a dialogue amongst each other. Then we have some questions because I was contacted by a number of people who cannot be here tonight who had questions, so I will offer up those questions. And I think Peggy has some questions. And then we're going to open it to you. So you'll all get a chance to get the information you need. So let me introduce you to Peggy Lascala. And she's NFRP's wonderful issues coordinator. And she will introduce our fine speakers. Thank you so much.
Okay, thanks. Hello, everybody. Tonight we welcome back two experts to the NFRPP. Our first speaker is William D. Cohan. He's a former senior Wall Street M&A investment banker and a New York Times best-selling author of 3 nonfiction narratives about Wall Street: Money and Power, How Goldman Sachs Came to Rule the World; House of Cards, A Tale of Hubris and Wretched Excess on Wall Street; and The Last Tycoons, The Secret History of Lazard Freres Co. His latest book, 4 Friends, Promising Lives Cut Short, is a memoir/biography about 4 of the author's Andover classmates. He is a special correspondent at Vanity Fair and columnist for the Deal Book section of the New York Times. Joining him is Nicole Gelinas. She is a senior fellow at the Manhattan Institute, a contributing editor of City Journal, and a columnist at the New York Post. She writes on urban economics and finance. Ms. Gelinas is a CFA charter holder and the author of After the Fall, Saving Capitalism from Wall Street and Washington. She has published analyses and opinion pieces in the New York Times, Wall Street Journal, the Los Angeles Times, and other publications. Before coming to City Journal, she was a business journalist for Thomson Financial, where she covered the international syndicated loan and private debt markets. We welcome them both.
Should I kick this off? I guess I will kick this off. I'm not here to talk about my latest book. Rhoda didn't want me to talk about my latest book. So you'll have to, if you're interested in the story of the fragility of life and how sometimes bad things happen to good people, you can pick up a copy of 4 Friends, which came out in July. I guess what I'm here to talk about is the question of the day. Are we heading into a new financial crisis? if any of you saw the op-ed that I had in the New York Times a couple of Sundays ago, you will know that I believe the answer is yes. I think I tried to make a very strong case for why the Fed should not lower interest rates anymore. The Fed chairman obviously does not take my advice. He lowered interest rates yesterday, and they had lowered them previously at the end of July. So to me, the next financial crisis is completely and utterly inevitable. And so, I don't really think that's necessarily something we have to get all crazy about, because, our very society is defined by financial crises. As I wrote in my book, Why Wall Street Matters, we've had financial crises throughout the history of this country. In fact, our country was born into a financial crisis when the federal government couldn't pay for the Revolutionary War and ended up compromising with the states and getting the states, the colonies, the states to pay, to assume the debt that the federal government had created in fighting the war, which is why the capital of the United States is no longer in New York, where it was at the beginning of the country's origin. Then it was in Philadelphia while they were building the swamp up in Washington, where it now is, and swampier than ever, I might add. So we've had financial crises in this country on average one every 15 to 20 years. There were financial crises in the world long before there was Wall Street, long before there was the United States of America. So, I think financial crises are part of human nature. What's just so astonishing to me is the last financial crisis that we all experienced. I mean, it was sort of like one thing to, be born like my father was into the 1929-30 financial crisis, and he just celebrated his 90th birthday yesterday. So he was still around for the one we had 11 years ago. So, I mean, if you sort of lived through the one 11 years ago and you weren't around for the one in 1929 or 1930, I can understand that. Maybe because you weren't around then, you were willing to repeat some of the things that caused that crisis. But 11 years ago, I would say most of us were around and we lived through it. And here we are repeating the very same things again now that we did back then. And it's just extraordinary to me that we're doing it. Except now it's actually much worse than it was then. So what do I mean by all that? So as someone who's written 2 books about that financial crisis, one House of Cards about the collapse of Bear Stearns, and the other Money and Power, how Goldman Sachs came to rule the world, the last third of which is how Goldman made it through the 2008 financial crisis in much better shape than everybody else. What I came to realize, plus having worked on Wall Street for 20 years, is that Wall Street is a very dangerous place. It always has been a very dangerous place, but we like to lull ourselves into a sense of complacency that it's really not as dangerous as it really is. Firms have been going in and out of business the entire history of our country. Ace Greenberg, who was the one-time senior partner at Bear Stearns, used to hold up what they used to call a tombstone ad in the Wall Street Journal or the New York Times. After a company did a financing or an M&A deal, the banks used to boast. They don't do this anymore, which is fascinating to me. But once upon a time in the 80s and the 90s, they used to boast when they completed a big financing or a big deal. And for instance, when there was like the Ford motor company IPO, which was the first big IPO that Goldman Sachs did that was not in the retail business or the sort of called the schmata business, which is what Jewish firms were allowed to underwrite in those days. But to get the assignment in the 1950s to underwrite the Ford IPO was a very big deal. And so it was also a very big deal, as in addition to being a big deal for Goldman Sachs to be able to do that. And so they would have these tombstone ads, and they would advertise in a full-page ad in the Wall Street Journal all the firms that participated in the underwriting. And for the Ford deal, there were, literally 100 firms that participated, with Goldman being the lead underwriter. And Ace Greenberg at Bear Stearns used to hold up these ads to the new young recruits who would come to Bear Stearns, and he would say, look at this list of firms, in 10 years, half of them won't be here, but we will be, because we're Bear Stearns, and what we do is different than everybody else does. We're much more conservatively run. We're much more careful about the risks we take. And so we will be here, but half of these firms on this page won't be. Well, of course, we all know that Bear Stearns is gone, that it had been profitable every quarter for 84 straight years until the fourth quarter of 2007, when it had its first losing quarter ever, and then before the next quarter could be completed, it was gone. How did that happen, and why are we facing a similar situation again? See, there's a major flaw in the way our banking system is run. You think that when you go to the bank, you're putting your money in to the bank, either through a direct deposit, or you go to an ATM machine, you go to the teller, and you expect your money to be there because you put it there. You think it's in there, and it's safe in the bank. And the bank actually contributes to this fiction because, not so much anymore, but in the old days, the bank was made out of, there'd be like this granite edifice, and you'd walk in and there'd be these huge barrel vaulted ceilings when you walked in, and then there'd be tellers behind a iron grated, apparatus that would give you the sense that everything was safe. And then if you looked at the corner of the bank, there'd be a huge vault, like 20 feet thick, and there'd be this elaborate steering wheel on the bank vault, and it was just open just imperceptibly, and you could look sort of around, and you could see what looked like money or gold or something valuable inside. And of course, it was all a fiction. It's all an act. Because if your money were really there inside the bank, then the bank wouldn't be able to make any money. Because how does the bank make money? It makes money by taking your money and lending it out to all sorts of other people in the form of mortgages, in the form of home equity loans, in the form of corporate loans, in the form of municipal loans. They use it to underwrite. They use it to trade. They use your money to make money. It's an incredible business, actually. They use your money to make money. And what do they pay you for your money? Well, as all of you know who look at your savings interest rates, your checking account interest rates, it's about as close to zero as it could possibly be. And it may, at some time in Europe, it's less than zero. So we're fortunate that it's slightly above zero, but basically it's zero. So they take our money, which they pay us nothing for, and then they lend it out for a very widespread, depends on the credit, of course, but 10, 8, 9, 10, 11%. So they're paying nothing for our money, and then they're lending it out at, say, 10% interest. So that is a really good business, and it's backstopped by the federal government, the Fed. It's backstopped by the FDIC. It's backstopped people's accounts are backstopped up to $250,000 by the FDIC. If you have a brokerage account, it's also has insurance related to it. So I don't think you can find one other business on the face of the earth that does not have to pay for its raw material. Banks don't have to pay for their raw material. They get it for free. Their raw material is the money that we deposit in the banks. When GM makes a car, they have to pay for plastic, glass, steel, aluminum, rubber, electronics, labor, whatever it is, they have to pay for. Banks, for their raw material, they get it for free. So then they lend that money out in the form of these corporate loans or all these other things that I talked about. And the system works great until everybody wants their money back at the same time. And then they all go to the bank because they're really panicked. There's something that's set off a panic. And they go to the bank and they discover that they can't get their money because what they don't realize is that their money was never there. And so they can't get something that was never there because it was being lent out. So that's what happened in basically every other financial crisis until the one in 2008. People went to the bank because something set them off. Another bank failed, land prices got too high, people couldn't pay their mortgages, whatever it was. They wanted their money, they all went to the bank at the same time, the money wasn't there, they freaked out, banks closed because people wanted their money, they didn't have it, they were not in business anymore, so-called run on the bank. In the 1929 and 1930s, there was huge long lines of people waiting to get their money at the bank, but they were never going to be able to get their money at the bank because their money wasn't there, and it was never there. And that's the fallacy of our banking system. It's called fractional banking, which basically means that you don't have to keep the money at the bank to be a bank. So we condone that, and it usually works beautifully until it doesn't. So what happened in 2008? Well, in 2008, it was a very different kind of run on the bank. It was what I call an institutional run on the bank because the FDIC had guaranteed the bank deposits up to $250,000. And so for most people, maybe not for Murray, but for most people, that's enough. And so, most people don't have more than $250,000 in their bank account. So it wasn't a run on the bank by individuals. It was a run on the bank by institutions. So the people who had their money at Bear Stearns, for instance, or at Merrill Lynch, or at Morgan Stanley, or Goldman Sachs, or at Wachovia, or wherever it was, they all worried that they weren't going to be able to get their money out of the bank. So they pulled their money out of the bank as best they could, and then a place like, for instance, Bear Stearns realized that it no longer had the money it needed to run its organization on a daily basis. Bear Stearns at the end had $18 billion of cash on its balance sheet, and it needed $75 billion a day in cash to run the business. And it got that money in what was called the overnight repo market. Now, you've probably been reading in the last couple of days about problems in the repo market. I'm not quite sure if it's the signal of something bad or just a technical issue, as some people have been saying. But basically, in March of 2008, Bear Stearns found that it could no longer borrow money in the overnight repo market, even though it was providing collateral in the form of various securities that it had on its balance sheet as collateral for these overnight loans. Basically, people stopped doing business with Bear Stearns. And when people no longer do business with you, even though you have $18 billion of cash on your balance sheet, you literally are bankrupt by the very definition of bankruptcy, which is that you can't pay your debts as they become due. So Bear Stearns went out of business because it could not pay its debts as they became due, because it could not finance itself in the markets, even on an overnight basis. It could not finance itself in the long-term credit markets, in the short-term credit markets, or in the overnight credit markets. And when you're a bank and you cannot finance yourself, you cannot exist. And so the problem that we had then, which is that people were taking risks they didn't understand. They had thought that they were taking all these mortgages that they had bought and repackaging them into mortgage-backed securities and selling them off to people as good investments all over the world. And they unfortunately were retaining the portions that they couldn't sell on their balance sheet, and they were trying to use that as collateral for overnight loans that they could no longer get. And so Bear Stearns literally went out of business. Lehman Brothers literally went out of business. Merrill Lynch would have gone out of business except it got bought by Bank of America. Morgan Stanley would have gone out of business except it got a huge cash infusion from the Japanese banks. And Goldman Sachs would have gone out of business, but it got a huge infusion from Warren Buffett and the public markets. So how did it all come about that people were willing to buy so many mortgage-backed securities that they did not understand? And why is that relevant to today? So the answer is that after 9/11, the Fed lowered interest rates dramatically and quickly from about 6% to 1%. And they kept those rates low for the next, that was 2001, for the next, 6 or 7 years. And what that did was that forced investors all over the world to seek higher and higher yields so they could get a better return on the money they were investing than they could by just buying treasury securities. So that led them to buy these mortgage-backed securities that were rated AAA by the rating agencies, which is a whole nother topic and a whole nother dimension of the fraud. But they were rated AAA even though they were yielding something like 6, 7, 8, 9%. So they looked like good investments. They were rated AAA, and it turned out, of course, that they were not good investments. And then when Wall Street kept selling them, despite them not being good investments, and people lost money on them, and then Wall Street was trying to use them as collateral for their overnight loans, and they couldn't do that, the whole thing came tumbling down. So fast forward to today, when after the financial crisis, the Fed lowered interest rates even further, which made sense in a sense because now people were worried that they couldn't get capital of any kind, and the people who could certainly didn't want to pay a high rate of interest for it. So the Fed lowered interest rates down from 1% or 2% to 25 basis points, and then kept that rate going for pretty much the next 7 or 8 years, and then also engaged in what was called quantitative easing, which was a Fed speak euphemism for going into the market and buying as many bonds as they possibly could and expanding their balance sheet from $800 billion to $4.5 trillion. And by buying all these bonds, they drove up the price of bonds, which lowered their yields. That's the way the bond market works. Higher price, lower yield. So they made sure that short-term interest rates were low, which is something they can control through the Fed's fund rate, and they made sure longer-term interest rates were low because of quantitative easing, where they went into the market and bought all of these bonds, drove up their price, created demand, artificial demand, where there otherwise wouldn't have been. And so both long-term and short-term interest rates have been kept low for now a decade. So again, as bad as it was leading up to the 2008 financial crisis because people were taking too many risks that they weren't getting rewarded for, now it's even worse, and it's been going on for 10 years. So this is why in my piece in the New York Times 2 weeks ago, I basically pleaded for the Fed not to lower interest rates again, because it's forcing people to take risks that they're not getting compensated for properly. And unfortunately, I'll give you a few statistics and then I'll stop talking. But we are literally, as a result of quantitative easing and the Fed's determination to keep interest rates low for so long, which was reinforced again yesterday, corporations have been literally rewarded. Everybody has been rewarded for borrowing money because interest rates are so low. And then you combine that with the tax deductibility of interest in most jurisdictions, people are literally being rewarded to borrow money. And we are literally awash in debt. There's something like $237 trillion worth of debt globally. I think most of you know that the U.S. Has borrowed, the national debt is more than $22 trillion, even though President Trump, then candidate Trump, said he was going to eliminate the national debt. He's now grown it from about 20 trillion to more than 22 trillion. We now have trillion-dollar deficits. The corporate bond market has gone from about a $5 trillion aggregate to more than 9 trillion. Some of our biggest companies, AT&T has 180 billion of debt. GE has over 100 billion of debt. Some of our biggest, most respected, most well-known American companies, which used to be AAA credit ratings, are now on the verge of being junk bond rated companies. They're in triple B rated territory. There's what people call now the triple B cliff. There's a great worry that these companies with all this debt are going to get, in an economic downturn, are not going to be able to pay back their debt, and people who own those bonds are going to lose a tremendous amount of money. I mean, people think that the stock market is the bellwether of Donald Trump wants us all to think that this high stock market means the economy is going great and it's the bellwether of wonderfulness. But really, it's the bond market that is probably twice the size now of the stock market. It used to be a much bigger multiple of the stock market, but of course the stock market has gone up so much that it's now only about twice the size. And when people can't borrow money, and when people start losing money in the bond market because the economy goes south, their credit rating gets lowered, interest rates start spiking up, then a tremendous amount of money is going to be lost. And people have been busy for the last 10 years bidding up the price of bonds, lowering their yields in what I called the yield Hunger Games. And so we have a situation that is completely untenable. It is actually much worse than it was in 2007 and 2008. And like 2007 and 2008, we do not know what's going to be the trigger for the trouble. Nobody rings a bell at the top of the market and says, this is it. It's all downhill from here. So we keep thinking it's going to be wonderful. We keep being told how wonderful it is from our beloved president. And so I have a huge concern as somebody who has been a banker and been a historian of the last crisis, that we are literally staring ourselves in the face of another huge financial crisis, that the Fed, again yesterday, under pressure from the president, under pressure from Wall Street traders and investors, once again lowered rates, which is literally the last thing that needed to happen, literally throwing fuel onto the fire that is soon to be a conflagration, in my opinion. And I'm saying this not as an economist, because I'm not, and I'm saying this, I was never a trader. I'm saying this as somebody who was a banker on Wall Street, who has studied this very, very closely, who understands the way financial crises happen and what triggers them. And basically, in my opinion, we have all of the ingredients that we need for a major financial crisis. The only thing good I can say about that if I may, and then I will turn it over, is that I believe it'll happen before November 2020, and I think that the only thing that is giving Trump any hope of being reelected is, a relatively strong economy. But I think given the actions of the Fed over the last 3 months and the bias that the Fed clearly has towards continuing to lower rates, which absolutely, as I say, blows my mind, and none of it's good enough for the president, who yesterday, even after the Fed lowered rates, even though I don't believe they should have, continued to insult the Fed chairman and ask for lower rates. I don't even think he understands what he's asking for. And so the only good thing I can see, even though it's a bad thing, is that the financial crisis will come now, in my opinion, before November 2020, and that should, I hope, be enough to flush the guy once and for all.
Well, I wish that I could disagree with much of what Bill said, but I largely agree. And first of all, I want to thank Rhoda and Peggy for having me back. I want to thank you all for coming. And I just want to address a different aspect that's really just the other side of the mirror from what Bill was talking about and some of the distortions in this economy. So I took a car here tonight, came in from Manhattan. If some of you are not familiar with how car service works in Manhattan, for those of us who don't drive, don't have cars, until 10, 15 years ago, we had two ways to get around besides the subway or the bus or walking. If you were in Manhattan and you planned to stick around Manhattan or not go very far, you just put your hand up and you hail a yellow cab. And this was a pretty efficient system. There were drawbacks to it, but the yellow cab pretty much got you from where you were to where you were going without too much hassle. If you were doing a different type of trip, if you wanted to come from Manhattan to go to New Jersey, if you wanted to take a trip where you couldn't be sure there would be a cab, say I wanted to leave my house at 2 in the morning for some reason, then you would pick up the telephone and you would call what was called a black car service, a radio car service, and you would arrange for the car to pick you up, take you where you were going. Not very difficult. And this was a profitable business for company owners, small businesses who owned black car service bases, and a profitable business for the drivers. Some drivers owned their own black cars, some rented them, some yellow cab drivers owned their own medallions, some rented them. But for the most part, everyone managed to eke out a profitable living. Now, tonight I took Carmel, which is a black car company that's several decades old. So the driver is continuing to try to eke out a profit in this business model. But over the past 10 years, this business has been entirely upended by, of course, as most of you know, Uber and Lyft. So I could, whether in Manhattan or from here or from many places in the country and around the world, pick up my phone, summon an Uber or summon a Lyft, get to where I'm going much more cheaply and in a nicer car in most of these cases. And so one would say that Uber and Lyft are a business success. Who could argue with the fact that I'm getting a ride in a nicer car for a lower price? But if you look at Uber, Uber went public, became a publicly traded company a few months ago. Uber went public even though in its first 2 quarters as a publicly traded company, it had more than a $4 billion loss. Uber's profit margin is more than negative 50%. Uber loses money on every single ride. And what's more, it does not have a path to profitability. So one could say, well, I've got this idea for this company, I need to raise money, I need to do this, this, and that. And once those 3 things are done, then I'm going to be making a profit and sending money home to my investors. But Uber has no credible path at all to getting to where it can return money to shareholders. There is no way for it to start earning money on the level of rides that it is providing. And that's why it's gone out and invested in new businesses like Uber Eats, bringing food to your house, scooters, where they lay out electric scooters all over Paris and other cities and people rent them. But these businesses are money-losing businesses as well. Same thing with Lyft. Lyft is Uber's smaller competitor, had about $1 billion loss during its first quarter as a publicly traded company. And then if you go beyond the car service industry, there's a company called WeWork, been in the news lately, company that also wants to go public, become traded on the stock exchange. This is a company that rents office space from office space owners and then turns around and rents that space to people who want to use the space. Now, this is not a very difficult business, but WeWork also manages to make tremendous losses every quarter. They're not public yet, but so far they've made losses in all of the quarters that they've been a private company. So take these three companies. The argument in favor of the idea that this is sustainable and that this is going to turn around is that these companies are innovative. They have to invest tens of billions of dollars in investor money in order to make their innovations pay off. But are they really innovative? Since I ended with WeWork, I'll go back to WeWork. WeWork is not an innovative company. Companies have been renting office space for decades, really more than a century. They do not own the property that they are renting out. And so it is very difficult to see how a company that rents property, which has been a profitable business for as long as anyone can remember, and operates this business at a loss, what innovation are they bringing to attract the marketplace? Uber and Lyft, when people like me criticize Uber and Lyft's business model, we often hear, well, but I take an Uber and it's so convenient and it's so nice and the driver is good and it's much nicer than an old smelly yellow cab from 20 years ago. Well, of course it's nice because the company is providing this service at a loss. If a company was out giving away diamond necklaces on the street, that would be nice too, but that is not what we generally think of as capitalism. And Uber and Lyft are not, what is the innovation that they are providing? Again, I could have called for a black car 20 years ago, 10 years ago. It would have been a little bit more inconvenient. I would have had to plan ahead a couple hours in advance. I would have had to use the telephone. But it is not materially different from what a person does today and using the phone to summon an Uber and Lyft. It is the same business of driving people around for money. So the innovation here in Uber, Lyft, WeWork, and I haven't even gotten into the exercise bicycle business, is to take a profitable industry for decades and turn it into an unprofitable industry. And really, to no apparent end, there are sometimes thoughts that Uber and Lyft, WeWork investors are putting these money into these companies because they hope to build a monopoly. And once they've built up this monopoly, then they will benefit from the monopoly profits that they can make. If there's no other car company besides Uber, Uber can jack up the price and everyone has to pay the higher price. But that is not going to work. There are no barriers to entry to this business. If Uber suddenly doubles the price of a car ride, a new Uber upstart can come along and start the whole process all over again and try to become the monopoly. Now, these companies are not startups. They are not 6 months old. They don't have a founder in a basement who's taking risks. All three of these companies are more than a decade old. And what's striking is that they were able to go public without, well, two of them went public, the other is trying. They were able to go public without showing that they can make a profit. Now, you may think, well, that's just how the startup world works. Well, that's actually not how the startup world works. If you look at the last two generations of startups, Amazon in 1997, when they went public, they had a loss, yes, but they were a very small company. They only had $200 million in revenue, and they had a loss of about 18% of that revenue. So their loss margin is much, much smaller than Uber or Lyft's margin of loss. And they were profitable very quickly after that. If you look at Facebook, Facebook was profitable when it went public. It was making consistent profits by the time it went to the public markets and asked unsophisticated investors to invest in it. Google was a highly profitable company well before it went public. Google did not go out and ask the public for its money before it could show that it could make a profit. And Google, Facebook, and Amazon, whether you think some of these innovations are good, bad, or neutral, they actually have changed the way that people live. I mean, we can't conceive of life before a search engine. Billions of people are on Facebook. And of course, Amazon has changed the way that we shop. That these companies did provide innovations and did show that they could be profitable in providing these innovations. Now, all of these profitable businesses, sometimes they invest in entities that don't make a profit, but overall, they are able to return a profit to shareholders every quarter and amass tremendous cash. Same with Apple. Apple was not able to go a decade without showing shareholders that it could make a profit, and indeed, before Apple revived itself with the iPod, the iPhone, starting in 2001, 2003, there were concerns that it would go out of business because it was not able to prove it could continue to turn over a profit above a sort of commodity, Dell gateway computer. So it's a very strange development that we have these companies that collectively are worth almost $200 billion, but yet their investors have not demanded that they be able to show that they can earn a profit. And if you go back to the last auto industry revolution, Bill mentioned Ford's IPO iteration in the 1960s. When Ford was a brand new company a century ago, Ford made a profit in its first year. It had 100 investors, and it turned over a $12,000 profit that first year. That showed people, I can make this product, I can sell it to people at a price that allows me to make a return, an important signal. Very different from sending people around in black car rides that don't pay for themselves for years on end. And so it is concerning that companies can go years and years without a profit and distort the industries that they're in. And it really changes the definition of capitalism in what may not end up being a very good way. It's very difficult for a cab driver or an old-fashioned black car driver to have confidence in capitalism when they have to compete against these companies that are able to make these losses for years on end. Now, why are these companies able to continue in business while not turning a profit? A lot of the reason has to do what Bill was saying. Money is very cheap, and it is very hard for investors to make a return. So investors go out and chase more and more risk, in effect destroying their own capital in search of a return that doesn't exist. And a lot of this does have to do with very low interest rates. If you've had interest rates that were close to 0% for more than a decade, and this is the result that we've come up with. Now, 0% and below 0% interest rates distort other markets as well. If you are interested in purchasing an apartment in New York City, apartment prices are well beyond the reach of people even who earn a good income. And it's not because the city is full. If you look at the census data on core Manhattan below 60th Street, the vacancy rate is close to 20%. If you come to the city and you look up into these new skyscrapers when it's dark out, the lights are not on. Nobody is home. And so one has to wonder, is this version of very low interest rate capitalism, if you can call it capitalism, is this actually working when we're spending all of this economic activity building these buildings that nobody lives in, where the people who actually work in the city have to put up with ever longer commutes? I mean, we've had tens of billions of dollars go into apartment buildings that no one lives in. Meanwhile, we can't come up with the money to build a tunnel to make the commute from New Jersey to New York much easier on people. So this is massive capital misallocation. And like everybody, I'm not sure how it will end up. but it is something to consider and think about. Is this really capitalism, and is it a good sign for if and when we do have another financial crisis? Are we going to peel off more people who have just entirely given up on capitalism, and do we get something that works even less well? And Bill, I'll just end, and then we can talk amongst ourselves. Bill mentioned politics, or alluded to politics, and said we could have a financial crisis before next November, and perhaps that would mean we would be ready for a new president. My concern or observation is that Trump could turn a financial crisis in his favor, that not so much that he could blame President Obama, but go back and blame 40 years of policy in replacing wage growth with debt growth. So in 1980, households had $1.4 trillion worth of debt that they owed. Today, households owe $15.7 trillion worth of debt. So the amount of money that the average household owes is up more than 10 times. And over that time, prices in general have only gone up 3 times. So this isn't an issue of inflation. And the population has increased by 44%. So it's not a population issue. People owe much more money than they did 40 years ago. And that's because their wages haven't kept up with the things that they need to buy. Credit card debt. We have $1 trillion worth of credit card debt. There's, by definition, if you owe money on a credit card, you can't pay it back, which means you shouldn't have borrowed it. It's not to say that people who owe money on their credit cards are bad people and they made a bad decision. It's just that they have no other choice because their wage growth has not kept up with the services and goods that they need to buy. So this debt growth did not start when Trump became president. It has certainly gotten worse since then. But when people assess what caused this latest financial crisis, they may not immediately blame President Trump. They may go back and look at some of these longer-term structural issues. And frankly, I hope that they do. Not that I would like to see President Trump reelected, but we need to look at these longer-term, multi-decade structural issues of why are we taking on all this debt, rather than say it's the Democrats, it's the Republicans, it's Trump, it's Obama, it's President Bush. No president has done a very good job of getting a handle on this and explaining it to the American people. But hopefully we are not too many financial crises away from realizing we cannot go on piling up this debt. It's not a sustainable way of running an economy. Thank you. Well, I can ask Bill a question that I thought of when Bill was talking. Given everything that you've written about the financial crisis and what you said about interest rates, do you think, in retrospect, that it was a good idea for the federal government, both through the Treasury and the Federal Reserve back in 2008, to put these extraordinary resources toward saving these financial institutions? Would it have been better in retrospect to say, Citigroup creditors, you've got to take a haircut. Bank of America creditors, you've got to take a haircut, and send a signal to investors. The government is not backstopping the financial system. You are taking some risk here. And might that have changed the last 10 years?
Yeah, it's a really good question, Nicole, and I've thought a lot about that question. So when the government decided to bail out Bear Stearns in March of 2008, I mean, it literally was going to go bankrupt. They had the bankruptcy papers ready to file. It was only over that weekend of the Ides of March that they cobbled together this deal with JPMorgan Chase. First, JPMorgan was going to offer like $20 a share. Then they realized there was nobody else around, so they offered $2 a share, which people thought was a typo because at one point, Bear Stearns had been trading well over $100 a share, close to $200 a share. And so then they also allowed JPMorgan Chase to pick and choose the assets that it wanted to buy from Bear Stearns, and allowed them to reject 30 billion of assets that the Federal Reserve ended up owning as well. So it was a very interesting deal. It was sort of cobbled together over that weekend. You may remember that it was announced at $2 a share, and then JPMorgan had to actually increase the price to $10 a share. Extraordinary. If you had bought the Bear stock when it was at $2 a share, a week later it would be worth $10 a share. You would have made 5 times your money. The reason that they had to do that was, I think, Jamie Dimon has always blamed the lawyers for that, but I think that it was a failure of JPMorgan Chase's management to think through the way they were going to run Bear Stearns during the time between the deal was announced and the time that the deal closed. But in any event, that was the first time in the history of the United States that the federal government saved an investment bank. Now, the federal government had saved banks, commercial banks, before. It had even saved or worked to save a hedge fund, long-term capital management, which was in the late 90s. But every other time, when I was talking about Ace Greenberg holding up the tombstone ad with 100 names of 100 investment banks that had underwritten these various deals, and half of them weren't going to be around. The reason half of them weren't around, and the reason investment banks went out of business, is because it was their partner's capital. If somebody screwed up inside the firm and took a risk that they shouldn't take, that was kind of the end of it. There was nobody there to backstop it. There was no one there to save it. And that was by design. And part of what happened in 1929 and 1930, the so-called Glass-Steagall Act of 33, I guess it was, the government basically forced banks to choose between investment banking and commercial banking, because they thought that investment banks were taking too much risk with a depositor's money, that money that we give them for free, that's their rocket fuel for making money. And so basically, people make a big deal out of the Glass-Steagall Act, but only one bank really had to choose between commercial banking and investment banking, and that was JPMorgan. They were like the first kind of universal bank back in the old days when it was still a partnership, and they chose to stay, believe it or not, in the commercial banking business. And that's how Morgan Stanley got started, because Mr. Morgan and Mr. Stanley used to work at JPMorgan, and they went across the street and they started their investment banking business called Morgan Stanley 85 years ago. And I was just interviewed for a documentary that the firm is making about their 85 years of existence. So that's why there was no safety net for investment banks until Bear Stearns was rescued in March of 2008. As I said, I've thought a lot about this, and I'm sort of the view that I understand why the feds decided that they needed to rescue Bear Stearns, make it the first Wall Street bank that they rescued, because, as they said, as people, the colloquial phrase is, it was too big to fail. Actually, it was too interconnected to fail. It had too many relationships with too many other firms on Wall Street, too many creditor, lender, creditor, trading relationships, and if it had failed, then it would have been a domino effect. So I understood why they did that, but unfortunately that led to a false sense of security. It sent the message to the rest of Wall Street, particularly Lehman Brothers, that hey, if the feds bailed out Bear Stearns, Lehman Brothers is 3 times the size of Bear Stearns. They're certain to bail out Lehman Brothers. That led Dick fall into this false sense of security where he actually thought he was going to be bailed out, which of course, as we now know, didn't happen. All of which is to say that I think that it would have been sort of politically and maybe sociologically unpalatable, except perhaps to Elizabeth Warren and Bernie Sanders. I think that they should have let Bear Stearns fail. I think that that would have sent a very powerful message to the rest of the Wall Street firms that they better do something fast, or else they're going to fail too. And by better do something fast, that means raising outside capital. You know, Jimmy Cain at the end refused to raise outside capital. You know, his stock was trading too low. He didn't want to dilute his shareholders. You know, Dick Fuld was traipsing around the world to Korea and China and other places trying to find capital. He refused to take new capital or to execute a merger. You know, the reason that Merrill Lynch was saved is because B of A bought it. Morgan Stanley, as I said, found new capital. Nobody wanted to buy Lehman except out of bankruptcy. So I think that mixed messages were sent by the bailout, and a better message that would have been sent would have been to let Bear Stearns fail. You know, creditors would have lost an awful lot of money. Lehman Brothers creditors lost 90 cents on the dollar. Incredibly, Bear Stearns creditors got 100 cents on the dollar, even though, because Bear Stearns became JPMorgan Chase. And so an incredible thing that happened during March of 2008 was that the bonds of Bear Stearns, the billions and billions of bonds of Bear Stearns, traded down considerably to like 30 cents on the dollar. And that people had bought insurance against those bonds, so-called credit default swaps, and had been paying premiums to buy those credit default swaps, that insurance. And those credit default swaps were worth an awful lot of money because the Bear Stearns bonds were clearly heading towards default, trading at 30 cents on the dollar. Well, so here's a situation where people did the right analysis. The Bear Stearns was basically heading towards insolvency. The bonds were trading at 30 cents on the dollar. Forget about the stock. The bonds were trading at 30 cents on the dollar. People bought insurance against that default, paid premiums for it. Those credit default swaps were worth an awful lot of money in March of 2008 until March 16th of 2008, when JPMorgan agreed to buy the company. All of a sudden, Bear Stearns credit became JPMorgan Chase's credit, and so-called fortress balance sheet that Jamie Dimon created. Bonds went from 30 cents on the dollar immediately to 100 cents on the dollar. So those bondholders made an unbelievable amount of money, and the people who had bought the credit default swaps, doing the right analysis, but betting that the bank was going to fail, the credit was going to fail, got totally screwed, if I may use that word. And it's never really been explained, you know, because no one had ever thought that that could possibly happen, because it had never happened before that the federal government had rescued an investment bank. So the long answer to that short question is that they should have let Bear Stearns fail. You know, the employees of Bear Stearns would have been fine, as they ended up being anyway. You know, those that wanted to stay in the business and could stay in the business. You know, the businesses, you know, just like the carcass of Lehman Brothers got picked over, the carcass of Bear Stearns would have been picked over. But it would have sent a very powerful message that didn't get sent to Dick Fuld, to Stan O'Neill, you know, to the rest of the Wall Street CEOs, that they'd better do something fast, or else they were going to go the way that Bear Stearns went as well, because it gets back to the way I was talking about before, the way Wall Street finances itself, which is it borrows short and lends long. It borrows in the short-term markets and it lends long, and there's been this colossal mismatch between its borrowing and its lending, and it's created, you know, it made itself very, very vulnerable to a run on the bank if people lose confidence, because ultimately Wall Street is nothing more than a confidence game. And and so is the banking system. And so when people lose confidence in it, it just evaporates immensely. And people wonder why they ever had confidence in the banking system once the confidence is lost. If you think back to 2008 and the way we felt in 2008, after Lehman Brothers filed for bankruptcy, we were wondering, is any financial institution safe? The borrowing costs spiked up to frankly represent the risk that was there, and the interest rates spiked up dramatically until the Fed once again came in to squash that. So that's my answer. Now, for you, Nicole, I would like to know if you think that the failure of WeWork to get public, and it was literally valued at close to $50 billion right before it went on the roadshow, and now they're talking about a valuation of $10 billion, even if it could get that, and it's, as you said, losing so much money, it's probably not even worth 10. Does this represent a sentimental change among investors, and is it going to, are we going to have maybe the start of more realism among investors than there has been in the last 10 years?
Yeah, I'm glad you brought that up, because I think it does represent a turning point, that over the past few weeks, for whatever reason, investors have become more skeptical. WeWork, a CEO named Adam Neumann, the company wanted to go public. They put out their offering documents to the public about a month ago when everyone was on vacation in August. They said they wanted to go public in September. Here it is September. They were unable to get the investor interest in order to drum up the money that they wanted to raise on a public offering. And so they have said, we are postponing this. It may end up being canceled, and it may be that Uber and Lyft were very lucky earlier in the spring in going public before this window closed. But I think if it is a turning point, as Bill said, no one rings the bell and says that this is the top, that this is over with for now. I think that's a good thing, because we need to get away from some of these distortions in the market before we can go back to what we see as the fundamentals in the market. So building more office towers all over London and New York because WeWork is going to rent them at an artificial price, this is not an economically useful activity. So the extent that we get it over with and say, no, this company is not worth $50 billion, it may not be worth anything, then we can sort of move on with our lives. But yeah, it's hard not to see it as a turning point, and one question is, what would make it turn back? What would make people feel confident that WeWork can be a profitable company? It's hard to figure that out right now, although these things will surprise you.
Do we want to turn it open?
So I have a couple of questions that came in email. And you mentioned Glass-Steagall, and somebody asked, would it be a benefit to bringing back Glass-Steagall?
So this is a question that I get asked a lot too, and people disagree. I know that my friend Elizabeth Warren disagrees strenuously with this. She's introduced a piece of legislation called the 21st Century Glass-Steagall Act. She keeps introducing it and never goes anywhere. And it doesn't go anywhere because it's not a good idea. Again, Glass-Steagall separated investment banking from commercial banking in the 1930s. You had a year to decide whether you wanted to be a commercial bank or an investment bank. Over time in my career on Wall Street, going from Lazard to Merrill Lynch to JPMorgan Chase, I was an M&A guy, somebody who advised companies and CEOs on mergers and acquisitions, and I worked at two investment banks, Lazard and Merrill Lynch, and one, commercial/investment bank, JPMorgan Chase, and my job never changed, during my whole 20-year career. I kept doing the same thing. It didn't matter whether I was doing it in an investment bank or a commercial bank. So by the time the late 1990s rolled around, you know, and the repeal of the Glass-Steagall Act came in 1999, it really didn't matter. I mean, there had been so many ways that the businesses overlapped, and and commercial banks were doing what investment banks were doing, and investment banks were doing what commercial banks were doing. I assure you that commercial banks doing investment banking business, which is what the Glass-Steagall Act was designed to prevent, commercial banks doing investment banking business is not what caused the 2008 financial crisis. If you look at where the origin of the 2008 financial crisis began, it began in the investment banks that were buying up mortgages and packaging them up as mortgage-backed securities and selling them as investments all around the world. That's what went wrong at Bear Stearns. It's what went wrong at Lehman Brothers. It went wrong at Merrill Lynch. All the firms. Yes, JPMorgan Chase was doing the same thing, but given its overall size, actually, Jamie Dimon is able to say, you know, we had nothing to do with that, even though, of course, they did. But Bear Stearns and Lehman Brothers, you know, were filled with all these toxic securities that they had actually manufactured themselves and found that they couldn't sell. And so their rescue came from the commercial banks. So the irony is that if commercial banks could not own investment banks, if Glass-Steagall Act were in fact had not been repealed in 1999, then a commercial bank like JPMorgan Chase couldn't have bought Bear Stearns. Bank of America could not have bought Merrill Lynch. Mitsubishi Bank may not have been able to make a big investment in Morgan Stanley. So the rescue that was concocted by the federal government was only possible because the Glass-Steagall Act had been repealed. So had it not been repealed, and had it, you know, Elizabeth Warren been in charge, a strict constructionist, then we probably would have had a meltdown of the financial system, which, you know, you could argue about might have been a good thing or a bad thing, but we certainly would not. You know, now it's like a dream. Did it really happen? You know, Donald Trump says it's the best economy ever. I mean, JPMorgan Chase is now making $8 billion of net income a quarter. I mean, it's never been a better time. It's kind of a new golden age on Wall Street because of all the money that they're making. You know, you could think that's a good thing or a bad thing, but it happened because there were no restrictions on commercial banks owning investment banks. So, no, it was not a good idea to restore it. You may not like them. You may not like Wall Street. You may not like banking, but our banks are the envy of the world. And so, you know, if you want to, it's like, you know, again, you may not like Google, or you may not like Amazon or Microsoft, but if you want to break them up, or Apple, if you want to break them up into their component pieces, that they're the envy of the world, you can do that, but you're kind of destroying one of the things that a lot of people think makes America successful and great.
Okay, that brings me to another question from one of our members who evidently read an article that said maybe a recession would be a good thing, that we could then focus on some of the important challenges that we are not addressing, and one of them is climate change.
Well, I don't think a recession would be a good thing. In the last recession, almost 9 million people lost their jobs. A very emotional, trying, you know, losing your job for a tremendous amount of time, breaks up families, causes people tremendous mental stress. And so, you know, we don't wish that. I don't think many people would wish that on anybody. But I do think it would behoove us to start planning for the most productive things we could do during a recession to make the recession easier on people, and also make sure that we're putting some of these idle resources to use so we come out of it better. And I think one of the main things, which actually goes along with climate change, is infrastructure. If you look back to the 2008 meltdown, the recession that we came out of in 2009, many people said, well, infrastructure is not a very efficient way of getting us out of the recession because it's a slow process, the jobs don't materialize quickly, there aren't a lot of shovel-ready projects. But we do have a lot of shovel-ready projects. I mean, we need a tunnel under the Hudson River. It's basically ready to go. It's just waiting for money from the Trump administration. We have many subway and bus projects, commuter rail projects that we could do in New York. I'm sure that New Jersey has bridges that are structurally deficient that could use investment, and many projects all over the country. And so it doesn't, and more importantly, it's not only the short-term jobs that you're creating, but when you come out of the recession, do people have better infrastructure so that they are more productive, that it's not taking them hours to get to work, that they're not suffering these delays that make them less ready to work when they get to their job. So I think infrastructure, and particularly infrastructure that has an emphasis on weaning us from these long one person in a car commutes. I think that would be we should have an infrastructure plan ready, and we should be signing an infrastructure plan into law now so that we've got these projects going and we can just sort of add more of them if we did to go into a recession. So I think that's one major place, whether you have a recession or not, but the benefit of it is bigger during a recession.
Okay, so I actually have a question. It's about this sort of disconnect you feel about the economy. So we hear from the president the economy is very strong, and there are things that would make you believe that to be true. So we've got strong consumer spending right now. We've seen positive but small growths in real wages. There are low mortgage rates, and I believe that home buying is up substantially. It's the highest it's been in 17 months. And we have this low unemployment rate. So how does that compare? Or I guess, so what is the significance of the report that just came out on Tuesday from the Business Roundtable CEO, the Economic Outlook Index, that reports the sentiment of major CEOs around the country, and it's down in 3 important areas. Their hiring plans, capital investment plans, and sales expectations are down quite substantially. So is this something that we should really be paying careful attention to?
Well, oddly enough, some of Trump's rhetoric about interest rates and the interest rate cuts that we've seen in the past 2 quarters, they may be adding to people's fears, because if you pick up the newspaper and you see on the front page, Fed has to cut interest rates. Jerome Powell, the Fed chairman, is saying, well, the economy could worsen. This is not very good for people's confidence. But yes, you're certainly right. It is good that we have record low unemployment. More people have entered the workforce, although the participation levels in the workforce are still not very good. They're nowhere where they were 20 years ago. I think it's maybe 69% of working age men are in the workforce. That should be a lot higher. But yes, I mean, it is good that people have jobs, that they're seeing raises, and we should certainly be grateful for that.
I would just add that I think there's a total disconnect between Trump's rhetoric about the stock market, how great the economy is going. I mean, he did promise as a candidate, 3, 4, even 5% GDP growth. We're still mired in the 2%, 2.5% area. Usually when, and here he is jawboning the Fed to lower interest rates. Usually when you lower interest rates when the economy is in rough shape, right? Because you want to make money easy for people to get to borrow, to build new plant equipment, to hire more people, to build a new manufacturing facility, to innovate. we've had low interest rates now, as we're talking about, for 10 years. We don't need low interest rates. If if the economy is doing as well as he says it is, then you don't need to have low interest rates. You should begin to make money more difficult for people to get. And by the way, as a relative matter, it's still the cheapest it's ever been in our lifetime. So his rhetoric, he obviously doesn't understand what he's talking about, which is, I mean, he thinks of it as a borrower. He is a premier borrower of money, okay? And he's a premier bankrupter of companies. So he thinks of it as a borrower. And yes, this is a great time to be a borrower of money. Fabulous. So he thinks the lower the better. And he also probably on some level knows that the federal government, which has a $22 trillion national debt and a $1 trillion deficit, that $1 trillion deficit, which garners headlines, would be a lot more if interest rates were higher. So he wants them to be low so that the $1 trillion deficit isn't a $2 trillion deficit, and he wants them low because he thinks, as a borrower mentality, that the lower the better. The more money you can borrow, the more money there is to borrow, it'll all just be better. He doesn't plan on paying it back anyway. He's not going to pay it back, the national debt. He's never paid back the money he borrowed as a businessman. So for him, it's all like the same continuum. But if you're an investor, to have these incredibly low returns on your money forces you to participate in what I call this yield hunger games, where you're constantly reaching for yield. You're constantly taking more and more risk that you're not getting rewarded for. Junk bonds, high yield bonds, should be yielding 10% or more to justify the risk that you are taking by lending money to a company with a junk credit rating. Now, junk bonds, look at today, they're yielding 5.5%. Some junk-related company just issued a bond below 5% last week. That's absurd. Investors are so desperate for that 5% that they're willing to take all this risk and not get the reward. That should be yielding 10%, not 5%. And it would be yielding 10% if the Fed weren't lowering interest rates, if the Fed weren't going along with this jawboning of interest rates needing to be down, and people would be getting a return for the risk they're taking. The best thing that was happening was last December, when no junk bond deals got issued, because investors said, no, we want higher yields, we're demanding higher yields, we are not going to buy this paper, we are not going to let you issue this paper at this low rate, and no bonds got issued, and the next thing you know, Trump is jawboning Powell about lowering interest rates, and then he caves. And he caved once, and now he's caved twice. So there's a huge disconnect. And there's, the only way out of it is financial crisis. The only way out of it is misery, I'm sorry to say.
Yes, you've told us your opinion about the bailout of the large banks, but what is your feeling about when they bailed out the auto industry?
I think they bailed out the auto industry because the banks failed. It's impossible to rewrite history. How might else have this worked out? But the auto companies started to fail because they couldn't get any type of short-term financing from the banks. Now, they had a lot of things they needed to do. They needed to rework their healthcare obligations with their employee unions. Some of the pension obligations they were never going to be able to pay. They built these obligations up in the 1970s, 80s, and 90s. But the immediate crisis meant you couldn't just let these companies fail with no lifeline. If it were a normal financial time, these companies could have gone bankrupt by themselves without government help. and gotten money from companies that specialize in lending money to bankrupt companies, but that just wasn't going on at the time. I mean, if you think about the airlines, major airlines have been in bankruptcy multiple times, and a lot of times the customers don't even notice. You know, the American, United have gone through bankruptcy, and people continue to buy airline tickets. They don't really see much of a difference because these firms step in and provide money, and the companies work out their obligations to their existing creditors, but that was just not happening during the financial crisis. And I also think, you know, socially and politically, how would you explain bailing out wealthy people on Wall Street and not bailing out working class, middle class people who didn't really make any mistakes, just going to work every day and hoping to have a job? So the short answer is, in retrospect, the government probably did have to step in and help out the auto companies, and things worked out probably as well as they were going to. Now, who knows what's going to happen with this GM strike, which I'm sure is also contributing to some of the stresses that we're seeing in the economy, particularly if it goes into the holiday season, because you'll have people who aren't, you know, you've got 44,000 people who won't be buying holiday presents. This has a ripple effect the longer that it goes on.
Thank you. Do you feel that our economy and financial system may be entering a perfect storm because we have all this uncertainty about tariffs? We have a stimulus in the Tax Cut and Jobs Act that we probably did not need. We also have very low interest rates. There's just with our policies right now coming out of Washington, there just seems to be a lack of clarity going on. Plus, we have slow global growth, and then we have low interest rates globally as well. What are your two views on that?
No, I think you're right that all of these things are they're meeting at one point, and maybe we will be surprised and it will all work out for the best, but there are certainly all of these different stressors that you mentioned. And when you say that interest rates are already low, that does mean that if we were to go into recession, it would be harder to cut them much more. I mean, what does the economy look like with negative 2% interest rate? You know, no one knows, and so that kind of adds to the uncertainty.
Yeah, I agree with Nicole, and I think that we're in a very sort of Orwellian time. You know, I think that you know, Trump honestly doesn't know what he's talking about, in my opinion. He is a very high beta individual. You don't know what he's going to do from day to day. I'm sure he thinks that is politically useful to him. You know, why is the round table, you know, why are they cutting investment in manufacturing, cutting people, you know, all that is because there's too much uncertainty, because, you know, Trump talks about tariffs. He never articulates why we're even in this dispute with China. I defy anyone in this room to explain to me what we're trying to accomplish with China, other than trying to, quote, get a deal. What does that even mean? So he's incredibly inarticulate. He's unbelievably poor communicator. We have no idea why he's doing what he's doing, other than to, quote, get a deal, and he's a great deal doer. So he's incredibly high beta. I think CEOs don't like that. They're risk averse. They want to know. You know, they obviously like the lower corporate tax rate. I mean, that's like manna from heaven. That's a gift, and that's what's sort of propped up corporate profits for a long time, as well as low interest rates. So it's sort of like this incredible morphine drip that we've had. We're kind of anesthetized in the economy. We think that it's going to be, we're told that it's going to be it's the best economy ever, and it's going to just keep getting great. And if the Fed would lower interest rates and the stock market would go up even further, I mean, what is this? This is, again, this is up is down, left is right. I mean, we're really through the looking glass here, I just think that there's so many factors that are going to lead to trouble. I would advise people who have, stock market profits to take them. Because it could turn on a dime, and I don't know whether this business, which I'm not fully sure I understand, this business of the Fed injecting $60 billion a day into the repo market, because there are higher rates yesterday and the day before in the repo market, the overnight secured financing market, 10%, than there are in the junk bond market. So something is cuckoo, okay? And again, I'm not an economist, but I know I'm a student of human nature, and I've seen this before, and I recognize the pattern. I recognize what's going on here, and all I can do is write about it. I don't work at the Fed. I've been writing about it, and people think I'm like a cuckoo clock, because even a broken clock is right twice a day. And so that's what people say to me now. You're like a broken clock. You're right, even a broken clock is right twice a day. But we'll see.
And you mentioned the tax cut. You mentioned the word stimulus. I agree that we did not need $1 trillion stimulus into the economy. We needed some corporate tax reform. We could have brought the corporate tax rate down and did a much smaller tax cut, but with lowering rates across the board, paying for it by taking away the state and local tax deduction makes it harder for the northeastern states to raise taxes when they're going to need taxes. The tax cut is enabled by low interest rates. If interest rates were 5-6%, the U.S. government could not afford a $1 trillion budget deficit. Now, people can say it's because of Medicare, it's because of Social Security. Those things are true, but if those things exist, then the last thing you should be doing is creating a much bigger hole for the federal budget when times are supposed to be good. Remember, when times are good, you're supposed to run a budget surplus so that you can run a budget deficit during the bad times. Now, there's a economic theory, many people associate it with the left wing, that says deficits don't matter, the US government can just print money. And so far, it's working, but the problem is it may not work forever, and with a Republican president and a Republican Congress saying we're okay with a $1 trillion budget deficit, makes it very difficult for Republicans to stay in the future. Democrats have to rein in spending. So now you have both parties that are getting accustomed to a world where you have a $1 trillion deficit, and I can't think that that's a very good thing for the long term.
I'm going to hand off the microphone, but I want to ask, where are you putting your money these days?
I don't give financial advice, but I think investing in the bond market is absolutely unacceptable. Cannot happen. Should not happen. You are asking for trouble, guaranteed. So that unfortunately leaves the stock market. And so in the stock market, there are a lot of companies. There are a number of public companies is half what it used to be. There used to be 7,200 public companies. Now it's like 3,500 public companies. But there are good quality public companies that are well run, that have a small amount of debt, that have high margin businesses, that pay dividends. That's what I would invest in.
You've been saying that in the 2008 financial crisis, the government was obliged to bail out the banks. There's always been a question, what happens to Joe and Jill? They lost their jobs, they lost their homes, they couldn't spend any money. The consumer market is 35% of the GDP or more. You can't kill that. What is going to happen the next time? Are we still going to be bailing out the banks and leave Joe and Jill on the street?
Well, first, I didn't say that the government was obliged to bail out the banks. I said they did bail out the banks. So there's a theory that without banks, I mean, look, we live in a capitalist system, okay? There are other systems, but we live in a capitalist system. And in capitalism, you need capital, private ownership, private capital to be made available to people, companies, universities, municipalities, everybody you can think of. You know, no capital, no iPhone. No capital, no job. No capital, no car. No capital, no gun. No capital, no chocolate milk. No macaroni and cheese, okay? Whatever it is. Without capital, I mean, we would have to live in a different system, okay? We live in a capitalist system, and at the left ventricle of capitalism, as I like to say, are the banks, is Wall Street. So if you could risk, now that's what we were sort of talking about before, you could risk not bailing out the banks in a situation like we had in 2008. And you would be, by the way, perfectly justified in doing so because they were the bad actors. Why should we bail them out? Why do they deserve a bailout? We should take the money and use it to give it to Jack and Jill, you were referring to. Let them pay off, give it to them so they can pay their mortgage or whatever, they can keep their house, whatever it is, pay their bills. And maybe we should have done that and let those banks go down the tubes and wait for a whole new banking system to emerge, which would have happened because we're an entrepreneurial society. It would have happened. And it may have looked the same, it may have looked very different, but it would have happened, but there would have been unbelievable amount of pay. I mean, you know, this time, you know, there was, 10% unemployment, and not to minimize the pain of 10% unemployment, but in the Great Depression, it was, 25% unemployment. There were bread lines. There were no bread lines this time. You know, there was no situation where people couldn't get their money out of the bank that they had put in. That's because the FDIC guaranteed people's deposits up to $250,000. That's why I said before it was a the institutional run on the bank, not a retail consumer run on the bank. So you could have done all that, and you would have been justified in doing it. You know, if Elizabeth Warren had been president, probably those banks would have gone right down the tubes, and she would have been completely justified in her theories and her economic theories and her political theories of doing that because they did this to us and they deserve the pain that comes along with it. Unfortunately, the truth is, I think that would have been a very high risk thing to do, and the consequences of it would have been, I mean, we might still be dealing with the consequences of that decision. So I can understand from a political point of view why Hank Paulson and George Bush and Ben Bernanke and Tim Geithner decided to bail out the banks, something they had never done before. Bailing out an investment bank, forcing mergers between banks had happened many times. This was another example of that. I think their first priority, they thought, was to save the financial system. I mean, Hank Paulson was CEO of Goldman Sachs. He understood how important, whether you like Goldman Sachs or you don't like Goldman Sachs, that the Wall Street financial system is to the proper running of our financial system, which is capitalism. If you don't save those institutions, then you're basically flushing capitalism, which maybe needs to happen. I don't know. I don't have an answer to that. We haven't even talked about income inequality and how ridiculous it is that, the top, whatever it is, 1% control 50% of the wealth in this country.
China is a large country, something that probably even Donald Trump knows about. And it has an increasingly well-educated populace, particularly in the technical area. Can you offer your thoughts, without using any profanity, about what you think about Donald Trump's trying to stymie the growth of China?
I think part of the political upheaval that we see is these massive imbalances that we've gone through over the past 40 years. And so people did lose jobs both to automation and to foreign competition. The sort of 80s and 90s era gloss that we're going to retrain people and they'll be fine, well, that didn't really work out for a lot of people, and that's partly what's contributing to this anger. And so I'm not sure that there's an answer. Did we have to accelerate China's inevitable entrance into the global economy the way that we did in the Clinton era and having them be most favored nation and all sorts of things? And have we policed the fact that a lot of competition comes from state-subsidized businesses in China? It is not what we think of as free market capitalism. It is state-directed capitalism. And importing hundreds of billions of dollars of products made under state capitalism distorts our own supposedly free market capitalism. And so, were we going to force them to be a country living in undeveloped conditions forever? No. But was it in our own best interest to speed this up? Probably not. And so whereas Trump is really more of the symptom of the failure to deal with this over 40 years rather than the problem. Can he, practically speaking, hold back their growth? Probably not. I mean, he can slow growth for a while. He might be able to cause a recession in China as well as here if he is too abrupt and goes too far with these tariffs. But they are what they are. They're a billion-person country that is intent on developing. So is he? What can he really do? I mean, we're not going back to the 1950s China. We are exactly where we are in competing with companies that in many cases have stolen technology and all sorts of things. But we are in a global economy, and we're not going to be able to protect ourselves from that.
Yeah, the only thing I would add is that, again, as I said before, Trump has failed to articulate what he's doing with the tariffs, what he's trying to accomplish. Something that he could be talking about that we sort of feel in our gut, this sort of business of them stealing our intellectual capital, our intellectual property, I think is legitimate, but he doesn't talk about that. All he talks about is winning a trade war, which he says is easy to win, which is obviously not easy to win. And the other thing is that he's going to be facing an election next November, and President Xi is the president for life. So he can wait out Trump easily. China always thinks in sort of 500-year cycles. We think of 4-year cycles. The other thing is that China is our largest creditor. They own more of our U.S. Treasury securities than any other country, more than $1 trillion. And so if they really wanted to mess with Trump, what they would do is start selling their Treasury securities, which would lower the price of Treasury securities, raise their yield because there was more supply than demand in the market, and that would sort of defy everything that the Fed is trying to do and the Trump is trying to do by keeping interest rates low. So they could really wait till when? a year from now maybe, and start dumping their treasury securities in the market, take their big gains that they must have in owning those things, and really screw with our economy big time by raising interest rates by doing that, and they could sink Trump, and I bet Trump hasn't even thought of that.
Well, on that cheerful note, should we take one more question? One last?
Hi, Nicole. You mentioned WeWorks, which has a flawed business model since it's not terribly innovative. Other companies have been doing it for years before it. This seems to be in line with the economist Mark Thornton's thesis in the book he published last year called The Skyscraper Curse. And I don't know if you're familiar with it. He's been cited in various business publications, and it's a very simple thesis. He didn't originate it. He just saw the data, which every time there's a major skyscraper built around the world that coincides with financial crisis. And right now, the highest skyscraper is being finished in Saudi Arabia. That's 1 kilometer high. So if Bill is right, that 2020 will be the year of the financial crisis, it's going to tie in very nicely with Thornton's thesis of the skyscraper curse.
Yeah, I mean, look at all of the skyscrapers that we've built in Manhattan, which are essentially empty. I don't think it's a good sign. It is not economically useful activity. My own theory is that whenever we start building the Second Avenue subway is when we go into a recession, because we started it in 29, we gave up on it. We started it again in the 1970s. We gave up on it when the economy went into crisis, and then we restarted it again in early 2007, and we went into a financial crisis. And this time, at least, we've built the first 3 stops. But Cuomo just said on Monday that we're going to build the next 3 stops, so you can take that as you wish. But we'd certainly like to thank everyone. Thank Rhoda and Peggy again. Thank you all for coming.
Thank you. Yes.
Oh yeah, go if you want to say. Yeah.
Oh. All right. 2 more.
Hi, my name's Patricia. As a student of FDU, I would like to know, because I feel we all technically heading to a next recession, I want to know how we can, not if we can fight it, how can we go through it with the least amount of damage? I hear you're saying don't invest in bonds, pull out your bonds, maybe invest in stock market instead. But as students, what can we do that will help us in the future, especially because we're soon going to be getting into the job field? How do we navigate a potential recession and if we're caught in it?
Yeah, I think it's a great question, and I would say the sooner you get into the working world, the better. So part-time job in any field, summer jobs, this is all useful experience, and just take advantage of the time that you have to be learn everything that you can, and be engaged in school, be thinking, be curious, be working, and hope for the best. What are you studying?
I'm actually studying criminal justice, but I'm here for the student newspaper.
Okay.
That's why I want to kind of get what the students can do, or what the students can do to help lessen the burden as our parents went through the 2008 crisis. So I want to know what we can do to kind of like either not go through that or not be hit as hard as our parents and everyone else was.
Yeah, you should not use a credit card unless you can pay it off, and take whatever don't live a lavish, don't spend lavishly, thinking that life's just one big party, which is hard for a college student not to think. And if you can begin to pay down whatever student loans you have, I would do that too.
And having part-time work helps you budget your time, and it shows potential employers that you're already attached to the workforce. So even though it may be hard, and oftentimes people's parents don't want them to have a part-time job during school, having that is good discipline.
One more question, last question.
You're welcome.
Okay, thank you. I want to answer one thing with you. 16 billion, if you invest $1 billion, you get 16,000 jobs in infrastructure. And New Jersey ranks at D- just about across the board, if you look at the American Society of Engineers, which rates the nation and the states. I'm talking about another issue. I was going to go for something else. I know you talk about bank and finance. I've been very interested in artificial intelligence. And within the next 2 years, the college students should know this and the public should know this. It's expected that the United States will lose 50 million jobs. Now, you can debate with Harvard Business Review or MIT or my good friend over here, Merrill, but that's a fact. And around the world, they're talking about 800 million jobs at least. What do you see? That would have a dramatic effect on this country.
Yeah, I mean, losing 50 million jobs sounds like a lot of jobs to lose, especially in an environment where we supposedly have the lowest unemployment rate ever. I mean, I've been a full-time writer for 15 years. I've watched, my entire industry literally go down the tubes. I don't know how anybody can be a writer or support themselves being a writer. If I hadn't been a banker, I couldn't be a writer because I couldn't afford to be a writer. I don't know why bankers get paid as much as they do, and they don't get paid as much as they do today than they did when I was a banker. I think the world is a dynamic, changing place, and we like to think of it as a safe and static place. But as I start, my book about Goldman Sachs, Wall Street has always been a dangerous place. The world is a dangerous place. It's changing fast, and it's tough out there. Yeah, I don't have an answer.
Okay, on that lovely note, we'll close tonight's program, and I want to thank our great speakers for informing us so well. And thank you for your good questions. Thank you. So maybe we'll see you on October 3rd at Ridgewood High School with Lawrence Lessig.